So discretionary income is the difference between your adjusted gross income and 150% of the poverty guideline for your family size. So in other words, anything you bring in that's over 150% of the poverty guideline is your discretionary income. Your discretionary income is calculated based on what you're reporting to the IRS as your adjusted gross income. This means any income going toward pre-tax items shouldn't appear in the income used to determine what you pay every month. So this includes contributions to 401ks or 403bs, healthcare, and flexible saving accounts. So family size. When we're talking about family size, when it comes to these repayment plans, your family size may be different from the number of exemptions you claim on your federal income tax return or the number of dependents you have defined by the IRS. Family size always includes you, your spouse, and your children, no matter where they live. If you're covering more than 50% of their living expenses. This also includes unborn children who will be born during the year for which you are certifying your income. And we'll go into the certification in a moment. For all the IDR plans we're discussing here, family size also includes other people if they live with you now, receive more than half their support from you, and will continue to receive the support for the year that you certify your family size. And so support includes housing, food, clothes, medical and dental care, and paying for college costs. So just keep these terms in mind, remember them, and we'll look at the different repayment plans. If you want to follow along in your resource guide, these are all listed on page 2. And we're going to keep putting this in the chat box and the actual resource guide files in there too as well. So the Department of Education has 4 of these repayment plans. The first, we're going to go over revised pay as you earn, income-based repayment, and income contingent repayment. So we're going to walk you through the basics of these plans, going from the most to the least generous. Again, this information will also be available to you when you use Summer. Okay. So let's go on to pay as you earn. This is the most generous repayment plan. It limits what you pay to 10% of your discretionary income. And the most you'll ever pay in this plan is capped at what you would be paying in a 10-year standard repayment plan. So this means that even if your salary increases a lot while you are still in repayment, there's a limit to how high the monthly payments will go. To be eligible for this plan, you must have taken out your first federal loan on or after October 1st, 2007, and have received a loan disbursement on or after October 1st, 2011. And your loans need to be direct loans. After 20 years of payments, any remaining balance is canceled. Next, we have revised pay as you earn. This limits your monthly student loan payment to 10% of your household's discretionary income. There is no cap to the monthly payments as in the revised pay as you earn. And so as your adjusted gross income rises, your payments will rise as well. You're only eligible for this repayment plan if you have a direct loan. Loan cancellation happens after 20 years if you have only undergraduate loans, and after 25 years, even if you took out $1 for graduate school. So if you have any graduate loans, that's a cancellation of after 25 years. Okay. So next we have income-based repayment, and this limits what you pay to 15% of your discretionary income. The most you'll ever pay in this plan is capped at what you will be paying in a 10-year standard repayment plan. You're eligible for income-based repayment if you have a direct loan or a federal family education loan, or FFEL. After 25 years of payments, any remaining balance is canceled. Okay. Have some water here. So now we have income contingent repayment. So this is very important for anyone with Parent Plus loan because it's the only plan those loans are eligible for. The rest of you will probably want to avoid this one. Under this plan, you generally pay 20% of your discretionary income. There's no cap to income contingent repayment plans, so the amount you owe every month will keep going up as your discretionary income goes up. You're eligible for income contingent repayment if you have any direct loan. After 25 years of payments, any remaining balance will be canceled. So this is just an important note. When we discuss discretionary income, income contingent repayment calculates discretionary income differently than other income-driven repayment plans. It subtracts only 100% of the federal poverty guideline for your family size from your adjusted gross income to figure out your discretionary income. So this means that more of your money is on the table for your loan payments. And then here's another note for married people or anyone considering getting married. If you're eligible for more than one of these income-driven repayment options, and one of them is revised pay as you earn, there is one other important factor married people need to consider. In pay as you earn, income-based repayment, and income contingent repayment, a married borrower may include their spouse in their family size and not have to include their spouse's income in their adjusted gross income, as long as they're filing taxes separately. Under revised pay as you earn, though, the government determines your discretionary income based on your entire household income, no matter how you file your taxes. So in revised pay as you earn, your spouse's income will be counted when you enroll. Okay. So that was a lot, and I just kind of threw a lot of information, a lot of definitions, acronyms at you. So we're going to go through a couple examples so you can get a sense of how these programs work. And remember, all of this is also available in your resource guide. Okay. All right, so here's an example. We're going to meet Anna. Anna has an adjusted gross income of $45,000, is married, and has 2 children. She graduated from college this past year and has a $30,000 direct loan. So under this 10-year standard repayment plan, the one that they automatically assign you after your 6 months, she would owe $311 every month. So we're going to do some math, which I'm not very good at, but luckily we have the answers here, to see how much she'd pay for under pay as you earn. So Anna has, with her adjusted gross income of $45,000 a year, for a family of 4, 150% of the poverty line is $39,750. Okay, so you subtract this amount from her adjusted gross income, so 45,000 minus 39,750 means that her discretionary income is $5,250. Because she's eligible for pay as you earn, you multiply that number by 10%, which gives you $525. And this is what she'd be expected to pay over a year. So you divide it by 12, and you see that she'll be expected to pay $43.75 every month. Okay. So if Anna's salary does go up in the future, the most she'd ever pay is $311 a month. And that's because pay as you earned is capped to what you'd be paying under the 10-year standard repayment plan. Okay, we're going to look at another example here. So meet Melissa. Melissa is married with 1 child and is in a situation similar to Anna's. Her adjusted gross income is $45,000 a year, and she owes $30,000 on her direct loan after graduating last year. Under the 10-year standard repayment plan, as with Anna, she would have to pay $311 every month. However, she has a family of She has 1 child, so for a family of 3, 150% of the poverty line is $32,940. So if we subtract this amount from her adjusted gross income, that means her discretionary income is $12,060. So because she is eligible for pay as you earn, we multiply that by 10%, which gives us $1,206. That's what she'd pay over a year. So again, divide that by 12, and she would be expected to pay $100.50 every month. And then again, under the 10-year standard repayment plan, she would be expected to pay the same $311 as Anna, because their payment plan is solely based on, this payment plan is solely based off paying off debt in 10 years, not what you earn or family size. Okay. So again, if you're like me, doing the math is a little bit difficult, but if you turn to page 3 of your resource guide, you'll see that we put together a grid so you can kind of get a sense of what you'd be paying. We show you how to do it, so if you enroll in one of these plans and feel like you're paying too much, you'll know how to check and make sure you're not being overcharged by your servicer. Okay. So these are some things to keep in mind when you're applying for IDR plans. So first, you must recertify your income at least once every year. Your servicer should send you an email or letter saying you need to recertify your income, but note this date on your own calendar too, so you remember to do this. If you don't recertify your income, you'll still be in the income-driven repayment plan, but will be charged what you pay in the 10-year standard repayment plan. Okay. If your income goes down, you should recertify your income immediately so you can manage your payments and have the extra financial flexibility you need. Anytime your income declines and anytime your family size increases, you should recertify. Okay. Second, don't delay in enrolling in an income-driven repayment plan because you're not sure which plan you're eligible for. If you apply with the Summer Student Loan Tool or using the studentaid.gov website, you'll be able to see which plans you're eligible for and what you pay in each. We recommend that you use AFT Summer Benefit to make this whole application process easier. However, if you are using the paper income-driven repayment plan request form, which we have included in the back of the resource guide, that's page 1 of 12 at the bottom. Just mark PAYE or pay as you earn when asked to select a plan. This is the best plan, and if you're eligible for it, you want to be in it. If you're not eligible for pay as you earn, your servicer will see which of the remaining plans you're able to move into and place you in the one with the lowest monthly payment. The sooner you move into one of these plans, the sooner you can start saving money every month. Okay. Third, Parent Plus loans are only eligible for income contingent repayment, but you must have a direct consolidation first. Parent Plus loans are excluded from most benefits provided by the federal government, but if you consolidate these loans, you will be eligible to enroll in income contingent repayment and public service loan forgiveness. You can do this at studentaid.gov, which is again listed on the first page of your resource guide. So one thing to note, it's very important that you do not consolidate your Parent Plus loans with any other federal student loans you might have, as this will limit the options you have available for paying back your non-Parent Plus loans. Okay, now how to apply for income-driven repayment. So to apply for an IDR plan, we again encourage that you use the Summer platform that's available. It's free to AFT members, and you can enroll in it at, well, we'll put the links right there. You can also visit studentaid.gov and click the Manage Loans tab to apply online. At both Summer and studentaid.gov, you'll be asked a few questions to help quickly verify your income. Before you complete your application, you'll be asked to use the FSA loan simulator to see what your monthly payments will move to and that you can afford them before enrolling. Finally, you have the option of requesting a paper application from your servicer or just using the one that we've provided in the resource guide. Finally, you should remember this: you should never ever pay someone to enroll you in any of these plans. If you're contacted by a company trying to charge you, again, file a complaint with the Consumer Financial Protection Bureau. It's important that we really kind of eliminate this predation on people with student debt. Okay. Now we're going to go through some of the pros and cons of income-driven repayment plans, starting with the cons. So the first con is that under current IRS rules, you may be required to pay income tax on any amount that is forgiven. There are many exemptions for determining if the amount forgiven will be treated as taxable income, and you should talk to a financial or tax advisor to see what your situation may be and how you can plan for that. So next, you may also wind up paying more interest under these plans than under the 10-year standard repayment plan. And this is because you're extending the repayment plan to 20 to 25 years instead of the 10 years. This isn't the case for everyone, especially for those who qualify for public service loan forgiveness, but you should just look at the numbers for your particular financial situation. And now going to the pros. Okay. Income-driven repayment plans are like a social safety net for student loans. You can always pay more than the minimum payment and pay off your loan earlier, but in months where something unexpected happens, you do have more flexibility. Paying more than the minimum amount will not affect what you were asked to pay. However, this option might not be for you if you're trying for public service loan forgiveness, which we're going to discuss in the next section. These plans are also better for most borrowers than programs like deferment or forbearance. A deferment or forbearance essentially suspends